watching the Mutual Fund Show. I'm Tamanna Inamdar. Today we're talking about small cap funds. Remember, this is the show where we discuss everything that matters to your mutual fund investments, what you should do next, and what is happening in the industry. The spotlight is on small cap funds because they've for long been called the hidden gems of the stock market. But if you get the formula wrong, they may also really mess up your portfolio due to the high risk and volatility associated with them. But with great risk comes great rewards as well. For many investors, small cap funds have turned out to be a game changer. The small cap 250 benchmark has in fact given a return of over 51% in the last 12 months. But the question is that, can the small cap run up continue? Is it time to revisit your portfolio when it comes to small cap stocks? Remember, in the last month or so, the benchmark has seen a growth of 7%. From the beginning of this year, the theme has been that maybe it's a return to large cap stocks. Now, considering the current scenario in the stock market, should you relook at your small cap funds? If you have fresh money to allocate, where should it go? And is a small cap fund the right destination? To speak on this and much more, I'm joined today by Rishabh Desai, founder of Rupee with Rishabh Investment Services, and Shweta Jain, who's the founder of Investography. Welcome to both of you, and thank you so much for joining us today on the Mutual Fund Show. Shweta Jain, let me begin with your take on the topic that we've selected today and the spotlight that we're putting on small cap funds. Has the story run its course, or much more to go when it comes to small cap funds?
So I believe that small cap as a segment is something that you can't ignore. I don't think it's run its course. I think it's something that every investor should have as a part, but depends on how long they can stay invested. So for me, it's a theme that goes throughout. It not necessarily as flavor of the day, and it's something that investors should always beware of or have caution, because this is definitely a very volatile category. It needs more time. So I wouldn't say that, it's run its course, but I think it's something that new investors should be wary about for sure. And I usually don't recommend that new investors, just start off with small cap funds, even if it's a small amount, because they do need to experience markets first. So that would be my take on this.
Okay, having said that, I think far from ignoring, investors have shown a lot of love for small cap funds. The question is it too much excitement when it comes to small cap funds right now, and is it time to temper this? Rishabh, your take on this?
Hi, Dabata. Thanks so much for having me on the show. I more or less agree with what Shweta had to say. See, small cap is small, mid and small caps particularly are mainly for like a long-term wealth creation process products, right? But from the current point of view, let me just give you some data points, which I found quite interesting. See, the money what you see which is coming in over the past 12 to 24 months is all thanks to the past returns. If you see the 3 to 5 year returns in mid and small caps, I mean, they have generated more than 20% CAGR returns. I mean, in many or in some of the funds, they have generated as high as 25 to 30% compounding returns. So the money what you see, what is coming in today's market is all thanks to the past returns. Now, if you see the price growth from January 2023 to July 2024, the price growth in mid and small caps has been, as high as 80 to 90%. I mean, if I include the month of August, it will be as high as 90 to 100%. But has the earnings grown in line with the price growth? My answer is a no. See, over the past 19-20 months, the EPS of mid cap 150 index has grown by around 6% in absolute terms, and small cap 250 has grown by around 13.5 to 14%. So I think this rally what we are seeing is largely a liquidity led rally in the mid and small cap space. I think, to answer your question, yes, this is a time to taper expectations down. This is a time to be more cautious in the mid and small cap space. Also, although we cannot predict the market going forward, I mean, markets can go further up. But I think, sticking to the underlying facts and figures of the markets is also very important, Tamanna.
Okay, so now having said that, and we're showing you the 1-year return, we're showing you outperformance and underperformance compared to the index. The fact is that the index has, in a lot of cases, performed better, if not almost at par with most of the funds. Rishabh, would that be one way to also look at small cap investments? Look at an index fund?
See, overall, if you see the mid and small caps index, both the indices have are very expensive today. So even if, for example, if I mean, of course, see today a lot of fund managers say this is a cherry picking market. I don't deny that fact. But today I am not comfortable putting in lump sum amount of money in the small cap space, mainly because it has rallied so substantially high. I mean, see, if I want investors expect high returns in small caps. So if someone is investing in today's market, then of course keeping expectations low, not even moderate, I would say little low is a wise thing to do. But down the line, I'm sure if the returns don't pan out the way they are, investors are definitely going to be disappointed. So number one, lump sum investments, I would put my money and my clients' money in the large cap space. But if someone has a longer time horizon and someone is investing via SIP methodology on a month-on-month basis, then definitely mid and small caps it can be continued in the SIP methodology, but not in the lump sum fashion.
Yeah. Let me just get that take with Ms. Jain as well. Shweta Jain also with us today, just on the fact that compared to the index, a host of small cap funds is perhaps not given the kind of return expected for an actively managed investment. In such a case, going forward, would you say a bet on the index would be more prudent?
Tawana, yes, great question, because we are seeing index funds, whether, started off with large cap index funds maybe 7-8 years ago, when this is a question that we were asking, can fund managers outperform the index, or can we do index funds and they give us similar returns or better returns? So I think there are periods when you will see that fund managers find it quite difficult to outperform the index as well. And I think these are periods where we are seeing a huge amount of liquidity in the market, huge amount of interest in the market, and pretty much a lot of these stocks are going up, some of them not deserving so. So fund managers may not outperform the index. So I would definitely say, keep an eye on the fund that you've invested in. Especially if it hasn't outperformed the index, find out the reasons why it hasn't. See what's keeping you in the scheme as well. And if it doesn't make sense to you anymore, it's a great time to review that portfolio and move to better funds. If whether in small cap, it's even a good time, I think, to look at your portfolio allocations and see if you're heavy on small cap, large cap, and if a revamp is in order.
Okay, a revamp is in order. In a typical portfolio, Shweta, what would be the percentage that you would allocate to small cap funds?
So for a new investor, I know this is going to be an unpopular opinion, but for a new investor, I wouldn't start with any small cap at all.
Okay.
I strictly stick to large cap. A year or so into the market, then get into mid and small cap because they have experienced a little bit. However, last 2-3 years have been very kind to investors, and they have actually just jumped into small cap. But I think that's a recipe for disaster in the future. So for sure, a small cap does need to be there, but I think not more than 25 to 30% for somebody whose experience hasn't been too much in the markets. But for a seasoned investor and for somebody who has a time horizon of 7+ years, and I think that's a good time horizon for small cap funds, 7+ years, then I think even up to 40%, I would go for somebody who's quite aggressive and young.
Rishabh, what would be your answer?
Tamanna, if someone has a long-term time horizon, say 7 years and 10 years, around 7 to 10 years, I think I would say 50% in large caps, 25% in mid caps, and 25% in small caps should do the job. So, I mean, rather than going into pure large cap funds, probably 50-60% can be allocated in flexi cap funds, because flexi caps are today heavily tilted towards large caps. So I think 50 60% towards flexi cap funds, and the rest can be divided into mid and small caps should do the job. The reason why I feel that, today mid and small caps cannot be ignored is historically what we have seen is that, mid and small caps have outperformed large caps over a longer period of time, right? And mid and small caps are more of like price momentum products, so they are always going to outperform in long term compared to the large cap segment. So I think, if someone is investing via SIP route, not lump sum again today. So I think of 50-60% in flexi cap and the rest in mid and small caps can be divided in equal proportion.
So the advice which we've just heard weighs in perfectly with the first query we're taking on the show today. And remember, the best part of the show is that we take your questions, and we tell you where to write in all those numbers on your screen as well, where you can send us your WhatsApp questions. But let me start with a question sent in by Ritobroto Mukherjee, aged 22, who asks and talks about their portfolio, says my portfolio is 65% large caps, 20% mid caps and 15% small cap. Is this equation good for a long-term investment? Rishabh, I'm going to start with you because you talked about someone with a 7 to 10 year horizon at age 22. Clearly, Ritobroto's horizon is much longer. With a 15% investment in small caps, are they being too conservative?
Tamanna, first of all, he has superb clarity of thought. He's at the age of 22. First of all, congratulations to him. I think the combination is great. I mean, if he's comfortable with this kind of allocation, and because 65% in large caps would kind of help him because he's starting his investment journey. So I recommend to maintain this allocation 65% in large cap, 20 in mid cap, and 15 in small cap. If he's able to take little more risk, then rather than going in pure large cap products, as I mentioned earlier, that invest 60 or 65% in flexi cap and the rest in mid caps. I think because flexi cap will flex around from time to time as and when the fund manager feels and appropriate calls would be taken in that product. I think just stick with this. He should be quite doing good in the long term wealth creation journey.
Okay. Shweta, you think his equation is perfect?
Yeah, I think it's good because though he's only 22, I think he's quite clear on how much is mid cap and lower on small cap. So I'm quite happy with that. 65% large cap is good. And also the fact that, he may be 22, but he may have started his journey maybe a year ago, maybe a year and a half ago. If he's just started, even then, if he's already put in money in mid and small, I think it's absolutely fine if he's aware of the volatility and the risks, which I think today's younger investors are quite well researched. I would be very worried if this was the other way around, where 65% was small cap and they would have just seen the past track records and invested. So I'm quite happy with the portfolio, and I think he can continue with this. And maybe even increase once he's seeing some bit of bonuses coming in and some bit of increments coming in. Maybe some bit of movement towards the small and mid cap, because his time horizon does seem to be quite long. So he could increase that. Today combined, that's 35%. So maybe could increase that to 40-45% as well over time.
Okay. Sanjeev is writing in to us, age 35, saying, I'm looking to start an SIP in Nifty 500 Momentum 50 fund. What's your view on this index fund? My goal is to make 3 crore rupees in 17 years. All right, so very specific goal as well. So by 52, Sanjeev wants 3 crore rupees and is looking to start this SIP. What is the amount that he needs to put in to make the math work? And what about this particular index fund they've talked about, Nifty 500 Momentum 50 fund? Shweta, let's start with you.
Yeah, so about 3 crores in 17 years is a reasonable target, I would say. And he would need to invest about 45,000 per month if he assume a 12% return. And I think that would do the trick for him. And for me, the only thing is make sure that it's a diversified portfolio. You're not sticking or depending on just one scheme to do this. So maybe divide this into 3 or 4 schemes. Nifty 500 Momentum 50 is a theme that we are seeing. Lots of NFOs, quite a few NFOs open as well. So this is something that I believe would be much broader than your regular Nifty 50. And I think the data supports the Nifty 500, especially where you're seeing a huge amount of performance difference from Nifty 50. So if Nifty 50 versus Nifty 500, I think over the last decade or so, you see a huge amount of difference in their performance. So where Nifty 50 has done maybe 23 times, the Nifty 500 is done maybe 30 times. So while that may be the past data, I would still say go slow with the Nifty 500 Momentum 50 Index Fund. This is something that he could start off. I'm also a fan of index funds and low cost funds. So I think this is something that he could start off definitely an SIP in. But like I mentioned, this should be just one of the schemes of his portfolio, not the entire portfolio.
Okay, so what should the rest of the portfolio look like, Rushabh, and what do you make of this particular fund that our viewer wants to invest in? That's the Nifty 500 Momentum 50 fund.
I actually have a little bit of a different view than what Shweta had to say. I think Nifty 500 Momentum 50, just one fund will do the job. This is a smart beta index, and I pulled out some very interesting data that on a 10-year daily rolling basis, this particular fund has been very consistent. It has actually managed to deliver greater than 15% CAGR returns more number of times compared to the traditional Nifty 500 index fund. And this particular smart beta fund has managed to even outbeat many of the flexi cap focused and multi cap funds. So I think just following the momentum strategy would do the job. This particular product will flex very beautifully between different market capitalization. Some couple of months back, this particular product was heavy on mid and small caps. Today it is very heavy, around 65% is allocated towards large caps. So I think just sticking to this one fund will do the job. I don't think he requires any other fund in his portfolio.
So yeah, this one fund will also do the job, that at least will make life simpler for you if nothing else. But of course, 17 years is a long time. So always time to reassess where your investments are going. Just on that note, Rushabh, a follow up there. How often should you reassess your portfolio?
Tamanna, that's a very great question. See, I would say at least, if someone is investing and created a portfolio today, give at least 5 to 6 years, right? See, because funds, particularly active funds, can underperform in 5 6 years if a fund is, say, value oriented. So value oriented funds can be a little more cyclical. So give it at least 5 years, and then, I mean, of course, see, reviewing on a yearly basis is very important. How your portfolio has grown, whether you are achieving your goal on a regular basis. I think that's very important. But in terms of particular funds, whether you should get out of a fund or no, I think give it some more time. So I think at least 5 years needs to be given to a quality fund, and then decide if the fund is dramatically underperforming, and you need to assess with the fund manager or with the AMC and asking them what exactly has gone wrong, what is the turnaround story, in how much time will the fund be able to turn around and go back to its outperformance. So these are multiple things which an investor should keep in mind, but at least give it 5 years, before kicking out a particular fund in one's portfolio.
Okay, so review every year, but give a longer rope to a fund performance, 5 years at least. That's the advice coming in. Ravinder has written to us, aged 57, says, I'm investing a lump sum amount in conservative, balanced advantage fund and equity savings hybrid fund. Is this the right decision? I'm looking to invest 45 lakh rupees as a lump sum amount. Shweta, I'll take this question to you first.
Yeah, so it's an interesting question because a lot of investors, especially who are coming from fixed deposits, find that the balanced advantage funds are a great route to start investing in, and indeed it is. But my only worry would be that he has the time horizon which I believe should be at least 3 years, then this is something that he can do. The schemes can vary, between conservative. Maybe he could get into one aggressive advantage, balanced advantage fund if that's suits his profile. But I think the information is a little too limited for me to recommend because 57 is still young. He does have a long time to stay invested. So I would definitely look at some a good balance between these schemes, and also put in some amount in equity if he's comfortable, or at least over time. Say start off with balanced advantage funds now, but in the next couple of years get into equity, and make sure that his goal of growth is met. It also depends on how much his portfolio is, where all it's invested, and what is the withdrawal amount he's looking at. So I think a lot of questions there. But if he's a new investor or an FD investor and moving to equities or mutual funds now, let me put it that way, then yes, conservative balanced advantage funds, conservative hybrid funds are a great way to start.
Okay, so that is a great way to start, Rishabh. But since it's a 45 lakh rupee lump sum investment and 2 funds have been identified, would you say it's the right decision? And see the age of the viewer writing in 57.
Tamanna, let me put it in this way. See, balance advantage funds are a little more aggressive than equity savings fund. Equity savings funds, of course, can go aggressive, but I would suggest, if he has around 4 years or 4 to 5 years of time horizon, then going into a balance advantage fund makes more sense. If he has a little bit of a smaller time horizon, say like probably 3 years or so, then going into equity savings funds makes more sense. But both the categories are very beautiful categories. Balance advantage funds will be little more aggressive because they will take little higher exposure in equity compared to equity savings funds. So I think the investor needs to be very clear of his risk appetite, which he's not mentioned. I mean, he's mentioned conservative, but I wouldn't put balance advantage actually as a conservative product. It's more of a moderate risk taker product or little lower aggressive product. But of course, if I have to use equity savings funds from a conservative point of view, then of course I would bet equity savings fund from the conservative point. But balance advantage products will be little more aggressive comparatively.
Okay. Arvind Rao writes into us, aged 40, says, I've invested in SIP in the Quant Infrastructure Fund, but the returns have been negative for the last 1 month. Should I hold or cancel this investment? Arvind, that's very little patience, isn't it? But having said that, that is the downside. Shweta, let me come to you first. The downside of a thematic fund is this, that they are slightly more high risk. Having said that, he is upset with the negative return for the last 1 month. Is that too small a window? Should this fund be given more time?
Absolutely. I think 1 month is absolutely no time being given to the fund. There must be a thought process that he had in mind when he started with this thematic fund, with this infrastructure fund. And if that has changed, that he doesn't want to take this kind of risk, because in the last 1 month, he would have also seen how volatile it has been. And if he's just not comfortable, I think the returns are secondary. His experience is more important than just this one scheme return. So I would recommend that he exit if this is giving him sleepless nights. That has nothing to do with the fund or the time horizon that has been invested in. It's just the nature of a thematic fund. It will be very, very volatile, and it might give you negative returns for a period of time before it suddenly spikes those returns, but he has to stay invested for that time. So if he's not comfortable with the nature of the scheme, absolutely exit. But if he's just saying, it has been negative for the last 1 month, so I want to exit, his time horizon should at least be 7 to 10 years in a thematic fund, or he has to get the entry and exit timing absolutely right, which is why I'm a little wary of thematic funds. It should never be more than 5 to 10% of your portfolio on the outside. So this is something that he has to figure out for himself or with his advisor. This is something that he has to see what he's comfortable with and take a call. If he has to exit, absolutely no problem. He could exit, but not just because it's been negative for the last 1 month.
Okay, so you need a better reason than that and a little more patience. I mean, the yardstick broadly that Rishabh talked about was review your portfolio once a year and give a fund at least 5 years. But would you give this fund 5 years, Rishabh? Okay, 1 month is too less. But on the other end of the spectrum, would you give it 5 years?
Tamanna, see, Quant has been able to manage their products exceptionally well. Today, if you see Quant, it's actually in the top five in most of the categories. Particularly for infrastructure funds, I'm not a very big fan of thematic and sectorial funds, especially what I understand, he's doing an SIP investment. So SIP investments may not work well, especially in thematic and sectorial funds, because thematic and sectorial funds can get very cyclical for a very long period of time. It can give probably no returns for 7, 8, or 9 years at a stretch. So I think, going in lump sum investments, timing it well, investing when the valuations are probably reasonable or dirt cheap, let me put it in that way, in terms of sectorial and thematic areas. I think that is a wise thing to do, and booking profits when the valuations are expensive, I think that is something what I would recommend. See, today infrastructure sector, it's trading at a very high premium, okay, and I'm not surprised the negative returns, because there has been so much of liquidity push in that sector, and it has given some phenomenal returns over the last 2.5 years. So I think he's chosen the wrong time to be in the wrong sector. I would suggest him to go for a flexi cap fund for SIP methodologies, or a focus or a multi cap fund. I wouldn't bet on a thematic or a sectorial fund today, especially an infrastructure fund for SIP methodology.
Okay, so maybe give it some more time. Maybe not as long as 5 years. All right, that's all the time we have. Thank you so much, Rishabh and Shweta, for joining us on this show today. Thank you, viewers, for tuning in. And a special thanks to those who write in with their questions. If you want to reach out to us, that WhatsApp number is on your screen. But that's all the time we have on the show for today. Stay tuned. A lot more coming up on the other side on NDTV Profit.